Welcome back. This is another episode of Chart Overload. I'm Ryan Mumy, CEO of Sollinda Capital Management, and with me is Justin Greenhill, our Chief Investment Officer. We're recording end of February. Jumping right in, first chart we're going to look at, big picture. Tariffs are in the news, and this shows pre-Supreme Court ruling to post what it looks like the new tariff rate's going to be. And I mean, the bottom line is, what I think when I see this is less revenue for the U.S. government and not that big of a deal in the grand scheme of things when we think back to what happened Liberation Day last year when all this came about. There was market sank, lots of headline risk for 3 to 4 months. Markets continued to power higher, but in the background there was these massive possible tariffs, and as we see now, they've come down quite a bit.
Could not agree more. I think the only takeaway, as you said, is the deficit situation. So with the tariffs, deficit's growing. Without the tariffs, it's growing more and growing fast. I think another little interesting caveat to this chart was if you look at some of the countries that were, saved the most by the Supreme Court decision, to call it that, countries that had higher tariffs, and now that the Supreme Court has ruled those are much lower, are some of the countries that their financial markets didn't care about the tariffs to begin with. Brazil in particular. So Brazil went from disproportionately high, top on the chart, to significantly lower in terms of the yellow dot, and there were bigger factors all along. So that's the theme. Deficit and the markets don't care.
Well, and the latest data shows that somebody's still buying China's stuff, right? I mean, they're not hurting as much as people were led to believe they would be by tariffs.
Well said.
Next chart looks at PPI, measure of inflation, producer price index, and came in hotter than expected, which, again, we've just come off this narrative that inflation was a one-time price increase and we should see it continue to level lower, and whoops, we've gotten some hotter than expected inflation readings.
Yeah, it's real interesting to say the least. So the narrative on the ground in terms of slow-moving economic indicators is actually that sort of the opposite of post-global financial crisis. Post-global financial crisis, it was increasingly, there was an oversupply of like commodities and inputs and things of that nature, but the labor market was increasingly tight, right? Versus now, what it looks like is a lot of these input items, this is PPI, so the prices that producers pay for goods and services before they sell them on to the end customer. Those items are kind of tight, but the AI narrative is looking more and more like it's going to make the labor market loose because a lot of more high-end white collar jobs are going to be displaced. So net, we're in a somewhat uncharted economic territory, over the last 20 years.
To be determined. Next chart looks at the orange line is gross domestic product. The blue line is effective federal funds rate. And, we went from really loose coming out of COVID to tightening to kind of, staying in the same range here of late, with a little expansion end of last year to now.
Yep. And this puts into kind of context what we were talking about. Even though both inflation and growth are higher than what they were, in many of the past couple decades, they're both actually higher by somewhat equal amounts. So the kind of net effect is, the Fed funds rate relative to growth is still pretty much where it's been, just both inputs are actually higher.
Yeah. I mean, this, you could say, we were talking about before the show, this could be a measure of the financial conditions. Are they loosening or tightening? And the bigger the gap between these two, with GDP being higher, could be considered looser financial conditions. So again, we'll see. The previous chart, inflation going up certainly doesn't lead to the probability of an aggressive Fed rate cut cycle, but to be determined. The next chart looks at the U.S. dollar relative to the Chinese currency. We've been in quite a down move here for the entire chart, but it's really escalated since really December, end of November.
And this just kind of goes to show, despite the fact that tariffs were put on, or at least supposedly to some degree. When I say supposed, I just mean there were lots of exemptions and delays, even in what was the most aggressive scenario. This just shows that the dollar has been depreciating versus the Chinese currency. So regardless, the big theme has been on the margin, money has started to favor things other than the US dollar.
Because if tariffs were working to their intended purpose, the dollar would not be in a free for all versus the Chinese currency. It just wouldn't happen.
It wouldn't.
Next chart looks at another topic we've talked about a lot: big tech, their CapEx spending, their free cash flow. Where's it going? It's been going to buy back shares of stock. And as we see from this chart, that amount of free cash flow that's going to buy back their respective stocks has went down a bunch.
Yep. And we've talked about this. So the, fundamental drivers or primary drivers of so-called big tech over the last 10 years has been high margins, and then been able to take that money and buy back stock, right? And that's definitely changed. Now
it's been a natural kind of lift to those shares, right? Is if all things being equal, you have the same amount of demand for people buying the shares. If the company's buying back stock, that means there's less stock to buy. So naturally, just basics of supply and demand, that raises the price. And this chart just shows that natural tailwind. It's not going away, but it's went down substantially. Next chart, moving into U.S. stocks. This is a fancy way of showing relative performance of the S&P 500 to the equal weight, which we've spent a lot of time talking about over the past over a year on this series. Equal weight recently has dramatically outperformed the traditional market cap weighted S&P.
Yeah, so this chart is market cap weighted S&P performance relative to equal weight over a 3-month period. So big takeaways are at major inflection moments in the market, like we saw global financial crisis, turn of the century.com, and recently you've got big swings, which really go to show that the biggest of big companies that make the market cap gauge different than the equal weight are becoming more volatile.
Next chart, just to reiterate that point, the Magnificent Seven. This is just the beginning of this year, so 2 months of 2026. We see here a pretty wide dispersion in their performance. And I mean, you look at Microsoft. I mean, Microsoft down 20%, Tesla, Amazon down a little over 10, but the major stock indices are about flat. The S&P 500 is roughly flat as of today. So to our conversation, the biggest of big are not contributing to the upside of the major indices, but the smaller components that are equal weighted and the equal weighted S&P index are carrying more of their weight.
Exactly. And year to date has really been kind of an audit to investors of, when you say you own U.S. stocks, what are you actually owning? Versus, depending on how that mix is constructed, you could be anywhere year to date from up close to 10% or more, or down 10% or more.
Yeah, it's truly, I love that. It's an audit of an investor's true diversification, not just at the headline or position level, but as we say, having a relationship with your money, actually knowing what you own. There's some folks that were maybe overweight the software component of technology, that their experience with a truly diversified portfolio investor with a diversified portfolio is much different this year, with some software names down 30% plus. So I like that, Justin. Next chart looks at January retail investors' net cash flows. So far in 26, despite the flat to slightly positive S&P 500, the retail investor since 2020, this is the most money they've ever pumped into markets on record.
Big inflows, and non-coincidentally, most likely, those big inflows have mostly went to the biggest of big companies, just based on index construction. And those companies have really kind of absorbed all that, gone nowhere, and in some instances gone lower. So flows have really been an interesting sort of in many instances kind of counter or a contrary indicator.
Yeah, I mean, it's the indiscriminate buying. I forget who it was, they talked about it. At what point does retail stop buying the dip because it's worked for so long? And this shows they've been buying the dip so far this year, if you will. If you call it a dip, there's dips all over the market. But to Justin's point, where a lot of the index level flows are going to the biggest of big names, that hasn't boosted them, right? They've continued to move lower in many instances. So I don't know. It's an interesting dynamic to continue to watch, because the counter to this is what happens if retail flows stop. This rapid ascent that we've seen since 2023. What happens then? And that's an interesting thought pattern. Next chart looks at the Goldman Sachs equity sentiment indicator, looking at investor, how they're positioned, etc. And the most recent reading was a negative reading, which again is counter to what we just talked about, what retail's doing.
Yeah, slightly negative. And, this takes in several inputs, but I think basically just what it shows that when you've got different areas of the market diverging so much from one another, it's difficult for a reading to be very strong in either direction, right? So, within that kind of middle range, or within from now where sentiment either goes firmly in one direction or the other, that would be, the more opportunistic moment for performance to diverge.
Yeah, because another popular reading of this is the bull bear gauge. I think USA Today does it, and it's neutral right now. So to Justin's point, it's a negative reading, but it's not necessarily really significant. It's more, where does it go from here? Moving on to our next section, non-US. This first chart looks at Asian stocks, the MSCI Asia Pacific Index, and it's off to a pretty good start this year, and a lot of that's been driven by February. Big gains in February.
Yep, huge gains for Asian stocks, in particular stocks outside of Japan. I think that's pretty notable. And Korea has basically been the driver there, so we'll use that to segue to the next chart. Recent ongoing rally in this next chart between Korea versus European equities, which have also been up quite a bit. Korea has now overtaken the market cap of both France and Germany, despite having as you see in the second part of that chart, having a much smaller GDP.
And that just, piggybacking on a lot of our previous content, there's a lot of money in the world that has been chasing U.S. equities or U.S. assets in general. And if just a fraction of those leave and start chasing some of these, what are much smaller markets than the U.S., it results in some pretty sizable gains. And one of those that we've talked about even last year is Korea, being kind of a hot spot of the AI narrative in the Asian peninsula. Next chart looks, shifting to the other side of the world, looks at Latin America. And this is the 12-month returns for four pretty sizable emerging market indices, three of which are individual countries. And as Latin American, they've all done obviously pretty well.
Yeah, the orange one there as a laggard has been Argentina, which had some pretty strong performance a couple years ago and has sort of kind of stagnated on its perceived reform trajectory. But that's obviously a much smaller market. The biggest market by far, Brazil, followed by Mexico, have continued to appreciate. We'll phase that to the next chart. That basically just shows flows. So this graphic illustrates Brazil, Latin American ETF in general, and then just the overall flows that have gone in there. And, biggest
a lot.
a long time. But to your point a second ago, Ryan, these markets are much smaller and have year after year after year for the last 10 years or more gotten relatively smaller to the U.S. every single year. So what looks like big flows in, although they are large, we've seen in other data not depicted this week that there's actually not been any rotation yet, because there's been net inflows to U.S. stocks also, back to our prior chart. So these smaller markets have gone up just by new money created, having a slightly different preference for it.
Yeah, and this is just the US market traded ETFs. This doesn't include big pockets of money that may be entering those markets directly. So it's an inexact science, but the fact of the matter is there's money going there, I guess, is our takeaway to Asia and to Latin America. Like, money's finding its way there, and our whole point is just wait. If this trend really continues and we start to see money actually leaving the US, these returns could look like blips on that possible future chart. Next section, looking at interest rates and credit. The first chart looks at corporate bond spreads, which we've talked about have been really, really tight, meaning the amount of interest you're getting for taking the perceived additional risk of corporate bonds versus buying U.S. Treasuries. It's been widening since bottoming at some point in January. And, where does it go from here? It's getting back in the range it'd been most of last year, following the Liberation Day blow up higher. And, where it goes from here, we'll see. We haven't seen any stress in the bond market in some time since Liberation Day last year. And so the question is, where does it go from here?
Big issues really are around private credit. So it's not necessarily so much that people think that publicly listed debt is going to get completely re-rated, but it really comes down to private credit. And then it also comes down to the degree to which AI might be creating some of this corporate debt, private debt, and may not actually get a commensurable payoff to that borrowing. So a lot of uncertainty, but it all kind of gets down to really everything is kind of AI still yet, isn't it? The difference is that, a couple years ago, everything was seen positive in terms of the market regarding AI, versus now we're seeing that outside of a few pockets of, supposed beneficiaries, like the raw materials that would go into it, pretty much everything else is now starting to look at AI as a risk, including the biggest of big companies that have a lead in AI.
Yeah. And, you raised a really good point that this is looking at like publicly traded corporate bonds. There's this whole other world of private credit that has attracted an immense amount of money, but it's illiquid and sometimes very illiquid, meaning you can't just go to a counterparty and easily transact it. It's much harder to transact, to get to unloaded, and that's where we've seen some of the headlines. There being some risks emerging. Jamie Dimon, a couple quarters ago, caused an uproar because he equated it to cockroaches. That there's some cockroaches lurking around, implying private credit, and now we're starting to see that with one of the largest private credit managers, Blue Owl, having to pause liquidations and liquidate some of their portfolio. What they're saying is not at unfavorable terms, but history will be the judge of that. So again, just looking at the entire credit complex, it's important to pay attention, because when there starts to be stress there, whether it's AI or it doesn't matter what the driver is, when there starts to be some fragility in the credit markets, it's going to bleed over into other asset markets. So again, that bears watching. Nothing necessarily is flashing red yet from our perspective. Next chart looks at the 10-year U.S. Treasury yield, and it's been fairly range bound, but I will point out that we did not miss an episode of Chart Overload without seeing Justin's fabulous artwork. So thank you.
You're welcome. So this is basically 10-year yield starting to break down from what's been moving sideways for some time. So the market is potentially looking into price in longer term uncertainties around the deficit, a little bit less, or we should say that's getting outweighed by the fact that, now the market is focused on the labor market potentially weakening, and some of these credit issues may be leading to perhaps lower policy rates as well. So
yeah, eventually everybody's right, and some people have been calling for a recession for 5-6 years. So maybe the bond market's starting to price that in. I don't know, but the fact of the matter is they've been moving sideways and they're starting to trend down. That means there's some demand for 10-year U.S. Treasuries that hasn't been there. We shall see. Last section, commodities. First chart looks at silver, which again we've discussed at length. We recorded one of these around the time when silver saw that ridiculous move lower. It stabilized and bounced higher a little here, and not a lot's changed, but we shall see where it goes.
From this chart, it kind of looks like it's maybe started a potential uptrend once again. So it certainly has found some buying, after that correction, but it's too early to say. I mean, that was a pretty euphoric top there. So to get back above that might take some time, if at all.
Yeah, you talked about this when it was happening, that it doesn't mean it's going to go a lot lower from here, and it doesn't mean it's going to go a lot higher from here. Things can trend sideways for a long time and just frustrate people. Last chart, looking at oil. That's been in the news because of the U.S. and Iran situation, negotiations. Are we going to go to war? Are we not? The oil market has continued to move higher the last couple of weeks.
Yep. Geopolitical risk, right? This is kind of something we continue to highlight. So there's kind of a looming situation around what's going on with Iran. And ever since Nicolas Maduro was captured in Venezuela, that was basically the oil market attempting to kind of move past what had been really multi-year lows. And that sort of got rejected and price squeezed a bit higher. So it's hard to necessarily get too bullish from here, just based on the supply outlook. But nonetheless, I mean, if there is a slightly higher, call it equilibrium oil price over the next 6 to 12 months, that certainly will change capital's preference for certain asset classes, whether that be energy stocks continuing to, have a strong relative performance, or, maybe even at some point, treasury yields probably look too low if oil prices are increasingly high. So we're really looking at oil more in terms of its knock-on effects, I think we could say, versus trying to have a real strong opinion either way here, because it seems to be unchanged fundamentally, but the market moves a lot on narrative as far as oil is concerned. It's very speculative.
And it's a big input on inflation ratings too. So
right.
To your point, the knock-on effects. Yeah, good stuff. Appreciate you tuning in. That was this chart overload. We'll be back in a couple weeks. If you have any questions, want to dig a little deeper into anything that we talked about, we're happy to expand upon anything. You can reach us at info@sollinda.com, info@sollinda.com. But like I said, we'll be back in a couple weeks. Appreciate you tuning in.